Welcome back to the Dividend Uncle channel, where we dig into the latest developments impacting your investments. Today, we're revisiting Mapletree Logistics Trust after the release of its Q2 2024 results in a shorter video format. You might remember that in our previous video, we took a deep dive into Mapletree Logistics Trust's market valuation, particularly the poor performance of its China assets, which account for nearly 19% of the trust's portfolio. Our conclusion? The market seemed to be overly discounting Mapletree Logistics Trust's other strong, resilient assets. But after these recent results, does that conclusion still hold? Let's dive in. Is reality what it seemed? For the first time in a long while, Mapletree Logistics Trust's typically steady performance took a hit. The distribution per unit, or DPU, fell by 6.5% quarter-on-quarter, which definitely raised some eyebrows. Now, if you're like most investors, you might immediately point the finger at the China properties, especially given their dismal rental reversion of negative 11.3% this quarter. This drag pulled the overall rental reversion down to just 2.6%. Without the China properties, Mapletree Logistics Trust mentioned that rental reversion would have been a healthier 4.6%. However, the deeper cause of the distribution per unit decline isn't China. The real culprit? Rising financial costs. Mapletree Logistics Trust's borrowing costs jumped by 3.3%, driven by additional borrowings of $179 million to fund recent acquisitions. As a result, gearing ticked up to 39.6% from 38.9%. Now, you might be wondering, is Mapletree Logistics Trust headed for trouble with these increasing financing costs? I don't think so. The trust still has a robust balance sheet. The average interest rate has stayed steady at 2.7% for the quarter, with 83% of its debt fixed, which provides some protection against rising interest rates. Mapletree Logistics Trust also boasts a high interest cover ratio of 3.1, and with only 3% of its debt maturing for the rest of the financial year, its exposure to interest rate risks is minimal. Now, before we dive into my take, if you're enjoying this content and want to stay updated on the latest investment insights, don't forget to hit that like button and subscribe so you never miss a video. Now, let's get into what I think about Mapletree Logistics Trust after Q2 2024. The Dividend Uncle's take. After reviewing the Q2 2024 results, it's clear that Mapletree Logistics Trust has faced a tough year, particularly with its China assets underperforming. Even the trust's CEO has acknowledged that these challenges are likely to persist for some time. But here's the silver lining. While the China portfolio is struggling, Mapletree Logistics Trust's other assets are holding up well. Global demand for logistics properties, especially outside of China, remains robust. International trade is still strong, and Mapletree Logistics Trust's assets outside of China continue to benefit from this trend. At the current price levels, Mapletree Logistics Trust presents a compelling opportunity. The market might be right in pricing in the continued challenges in China. But for long-term investors, this could be a chance to lock in a decent 6.9% dividend yield while waiting for the tide to turn. It's a classic case of being greedy when others are fearful. Mapletree Logistics Trust's overall portfolio still offers a lot of value, even if we have to ride out some bumps along the way. So there you have it. While Mapletree Logistics Trust's Q2 2024 results reflect some short-term challenges, the trust's diversified portfolio and solid financial fundamentals provide a strong foundation for potential growth. For investors with a long-term perspective, the current price levels present an opportunity to capitalize on Mapletree Logistics Trust's resilient assets and attractive dividend yield. As always, do your own research and consider your investment goals before making any decisions. Stay tuned for more updates on the Dividend Uncle. Thanks for watching.